Good afternoon, class.
Good afternoon, sir.
Okay,
Good
good.
afternoon, sir.
Good afternoon, sir.
Good afternoon, everyone. I welcome you
Welcome,
all
sir.
to Equity Professionals. My name is Wasiu Okpola. Wasiu. Written this way, Wasiu Okpola. You can see some familiar names here, people that have taught the last diet. So I'll be taking you through strategic business reporting for this diet. Yeah, sorry. So, as I was saying, I'll be taking you through strategic business reporting for this diet. And what you can see on your screen is the plan, is the cost allocation on how we're going to navigate through the syllabus for this diet. There are some things that might change for now, which will let you know in due course. So today is my first class with you, being week 1. Today I'm supposed to cover ethical issues in strategic business reporting and also regulatory framework of strategic business reporting. Hopefully, when we are done with that, then on Wednesday, because we'll be having 2 classes in a week, on Wednesday, we would immediately start with IFRS 2 on share-based payments. So IFRS 2 on share-based payments will take around, let's say 3 classes, around 3 classes. Then, when we successfully scale through that, we'll move to IS 19 on employee benefits. That will also take us 2 classes, so that as we are finishing a topic, we are solving sufficient past questions. So, just to prepare you for exactly what you'll meet in the exam. When we are done with that, we'll move to financial instruments. That will take us roughly 3 weeks. Yeah, 3 weeks, where we look at financial assets, financial liabilities, impairment of financial assets, and all of that. Then, when we successfully do that, then we'll be in August already. Then in August, we would move to group financial statements in August. And I will take the whole of August. The whole of August will be dedicated to consolidated financial statements. So basically, the focus here will be to teach you the principles of complex group, the principles around the fellow subsidiary, sub-subsidiary, even foreign subsidiary, disposal of interests in a subsidiary, consolidated cash flows. It will take us roughly 5 weeks to cover. Not 5 weeks, 4 weeks, but around 7 classes. So 7 meetings. We would be done with group financial statements, I think around 3 weeks, since we'll be meeting twice a week. So week 1, week 2, like that. We should be done with the principles of group account. Then we would have solved few past questions and which you're going to see how those questions are set in the exam. Then, when we are done with that, move to September. And in September, we would look at IFRS 15 on revenue from contract with customers. That will take 2 weeks. It's a wide standard. So, and in order to cover it adequately, 2 weeks for us to finish that. Then, earnings per share. Earnings per share will take also 2 classes for us to cover it appropriately. After that, we'll look at interim financial reports and also accounting policies. That would take us a class to deal with that. Then leases. Leases will take 2 classes for us to be able to deal with. Then we move to interpretation of financial statements, 2 classes. To take us 2 classes to teach you how to interpret and analyze financial statements. Then sustainability reporting framework and integrated reporting, 1 class. And also impact of changes in accounting regulations, along with we'll teach those ones together in the same class because they are theoretical, so it won't take so much of our time. Then other current developments and beyond financial reporting, 1 class. So here I'll be teaching you things like risk management. We'll be looking at things like corporate governance. We'll be looking at things like ESG, environmental and social reporting. All of that will be considered in October 11th, 1 class. Then we'll move to income tax. That will take 2 classes to finish within a week, 2 classes. Then provisions, a class to take provisions. Then we'll move to some minor standards like inventories, agriculture, accounting policies, borrowing cost. We'll walk this through like a revision. We'll just come in run through the standards with you, just for you to have knowledge of them, because your syllabus do require you to know them. We'll do the same thing for PP, intangible asset, and investment property. The same day, we just run through the standards, just for you to have an idea of those topics. Yeah. And that should be the end of our class, really. We'll have covered everything in your syllabus. So ideally, this is an extract. I extracted all this from your syllabus. And we have been teaching this week in, week out. So another person might join me in the course of the diet to take this, whereby we're going to be two that will take some of these topics. But for now, I'm assuming that I will be taking you through pending when another person will join. So that is what we have for this diet, and that is how we want to navigate through the diet. Do we have any questions before we move to the business of the day? And you can see it clearly. And everybody
Yes,
can
I can
see
see it, sir. I can see your new screen, sir.
Good. Okay, good. Okay, so now the first part of the syllabus that we are going to start with today is called regulatory framework. And for regulatory framework, what we want to look at here, in fact, what regulatory framework is looking at are the regulations that governs reporting, or the regulations behind reporting itself. So there are two things that we want to cover in regulatory framework. Number one are the regulations themselves. What are those regulations that governs reporting? And number two is the regulatory bodies. Regulatory bodies that develops these regulations. If we're able to successfully cover these two, then we are done with regulatory framework. Then we can move to ethical issues in business reporting. So this two is the regulatory framework. Let's start with the regulations that governs reporting in Nigeria. See, when we say regulation, for example, now in the banking industry, they have a lot of regulations. They have things that they must do. They have things that they must not do. CBN has set ways and manner in which they must do things. There are regulations that guides their operations. The same thing in reporting. In reporting, we have regulations. And for us, these regulations, we call them gap. We call them gap. And I'm sure some of you will know the meaning of gap. Can anybody help us with the meaning of gap? Generally accepted accounting principles. That is gap. Generally accepted accounting principles. This gap is what we regard as the regulation that governs reporting. And you see, this gap, what you will find in a gap are majorly the rules and the principles that governs reporting. The rules and the principles that governs reporting. And these rules and principles, what are they? What are these rules and principles? There are three of them. There are three of them. Number one is the accounting standard. These are the rules and principles, and that's what we call gap. Number two is the company law. Number three is the local stock exchange listing requirements. The local stock exchange listing requirements. So these three are the regulation that governs reporting. These three is what we call gap, or rules and principles. And these three are basically what we want to talk about. So the first one, which is the accounting standard. Almost every one of you should have heard of an accounting standard. So accounting standard are basically what guides accountants, what guides entities on how to prepare and present their financial reports. It's the accounting standard that guides us on how we do that. And it's usually authoritative. It's like it's an authoritative statement because it tells you exactly what you should do and you have to follow it, right? So in Nigeria, the accounting standard we use is the IFRS or the IAS. The accounting standard we use in Nigeria is the IFRS or the IAS. The IFRS is International Financial Reporting Standard. The IAS is International Accounting Standard. Is there any difference between IFRS and IAS? No, there's no difference between the two. They are the same. Just that IAS was the accounting standard we had before now. We had IAS. Then, over time, where there was a change in the constitution of the body that was developing the IAS, then they said that, okay, all accounting standards we are going to be issuing going forward should be called IFRS. So they are practically the same thing. Like the most recent change is IFRS 18. IFRS 18 used to be IAS 1, but now when they updated IAS 1, they changed the name from IAS 1 to IFRS 18. So what they are doing right now is anytime there is a change, there's an update to an accounting standard, what they simply do is to change the name from IAS to IFRS. Or when they issue purely new standard that does not exist before, they won't call it IAS something, they will simply call it IFRS. So they are the same. The second one is the company law. The company law is also a gap. The company law also helps in preparation and presentation of financial statements. Example of company laws that we have in Nigeria is SCAMA 2020. And what is SCAMA 2020? That's the Companies and Allied Matters Act. There are a lot of sections in CAMA that prescribes how we prepare and present financial reports in terms of majorly share capital, how we determine our share capital, the name we call them, how we issue them, how we redeem them, can we reduce them, right? All are contained in CAMA. It's CAMA that prescribes how companies present their share capital in the books. CAMA also deals with issues around distribution of profit as dividend, retained earnings, and some other areas like that. So CAMA is a regulation that governs reporting. Another company law is the BOFIA, also 2020. BOFIA is Banks and Other Financial Institution Act. The most recent update is that of 2020. This act majorly deals with banks or entities in financial services. It is also a gap because there are some sections in BOFIA that specifically dictates what figures should be put in the financial statement of banks. Example, Section 15 of BOFIA requires that banks must make statutory reserves. And these statutory reserves, they now put conditions that, okay, if the company's PAT is higher than their paid up capital, then the company should make a 15% statutory reserve and all of that. But the point is this, BOFIA is dictating what goes into the reports. That makes BOFIA a gap. That makes it a regulation that governs reporting. So it's a company law. Another one is the Financial Reporting Council Act, also of 2020. It used to be of 2011, but now it's 2020. Now, you see, the Financial Reporting Council Act was the act that established the Financial Reporting Council of Nigeria. And you see this act, it's the act that enforce or strengthen the Financial Reporting Council of Nigeria to ensure that all companies comply with IFRS. So every company now is required to prepare their financial report in line with IFRS. Particularly, there are some set of companies that we call public interest entities, PIE. So the focus is more on this set of companies or this set of entities because this act mandates them to prepare and present financial reports or financial statements. It's compulsory for them. Not that other companies that are not PIE are not supposed to present and prepare financial statements, just that the spotlight on PIE is more than other entities. And when I say PIEs, I'm talking about companies like listed entities, okay, like banks, or regulated non-listed entities. Okay, like it's not all banks that are listed. I'm sure you know what a listed entity is. Companies that are quoted on the stock market, right? Is even at the level of banks, it's not all banks that are listed. There are some that are not listed. But those in that industry or in that sector are highly regulated. So any entity that is not listed but is highly regulated is a PI. Also, are PLCs, public limited companies. They are PIs or any governments or government agencies or parastatals. Name them, maybe NIMASA, maybe FAN, maybe NDPRA, maybe in Lagos State, maybe LSDPC, any government arm is a PIE. Or there are some companies we call concession entities. Concession entities are, for example, Nigerian airport, for example, now. You know, Nigerian airport is managed by a private entity. And this private entity, the government will have told them that, okay, manage this airport for us, collect tolls, collect money, collect fees from airlines. I mean, whatever you have to do. Just ensure you deliver 1 billion to us every month. But the management, the development of these airports resides on you. Whenever a public infrastructure is handed over to a private entity to manage, it has to be a concession. That's a concession arrangement. In Lagos State, we have a Lekki toll gate. It's managed by a private entity under a concession arrangement. So that private entity that is managing a public infrastructure is a concession entity. That entity is a PIE. Or a privatized government entity. A government entity that was privatized is a PIE. You see, most of these banks now are going into old co, right? Where there's a parent that has subsidiary. You see that the holding co itself will now be a private company. See, those old co, those parents, they are PIE now. They are PIE. We could go on and on. Also, very importantly, government contractors. And these contractors who get contract of above 1 billion naira is a PI or a private entity whose revenue is above 30 billion naira is a PI. These are PIs. The Financial Reporting Council Act requires that they have to present financial statements annually and is compulsory for them. In fact, not just preparing and presenting to their investors, they must submit this report to FRCN, Financial Reporting Council of Nigeria. In fact, now FRCN has if you go to their website, there's this online repository they have where you can those companies can just upload their report. So, I mean, it reduces manual submission and makes it easy for companies to comply with that directive. Okay, so back to the main thing. We are talking about the FRC Act. It is also a regulation that governs reporting in Nigeria. Another regulation or company law is the tax law. It is a company law because when you look at the tax law, it is the tax law that would tell us the rates for how you determine your withholding taxes, your VAT, your PIT, and all these, even your CIT. And all these figures, we put them in the annual report. So the tax law is a regulation that governs reporting, just that it now falls under company law. Okay, so that's that. So we have talked about accounting standards, right? We have talked about company law, and I've given you examples and why they are gap. The final one is the local stock exchange listing requirements. Local stock exchange listing requirements. And from the name, local stock exchange listing requirements, they contain checklists or requirements that companies must meet if they want to be listed on the stock market. Requirement that companies must meet if they want to get listed on the stock market. Additionally, listed entities must also prepare certain reports to SEC, Security and Exchange Commission, all the report they're supposed to prepare and in which format they should present those reports, all will be found in these local stock exchange listing requirements. And these three that I've explained to you critically are the sources of accounting regulation. They are the regulation in Nigeria. The accounting standard, the company law, and the local stock exchange listing requirements. Do we have any questions? Okay. Now, before I forget, I mentioned rules and principles. Are they the same thing? No, they are not. Because when I started with regulation, I said they are gap. And generally, that's the regulation that governs reporting. I said this gap they are majorly rules and principles. And I said these are the rules and principles. So don't take it as rules and principle means the same thing, because rule is different from principle. In fact, some countries, their own regulatory framework, their regulations are entirely rules in some countries. Their regulations are entirely rules. While in some other countries, theirs is entirely principles. So it depends on which country that you're present. So what's now the difference between a rule-based framework or a rule and a principle? You see, rules are specific guide, not even guide, specific statements or specific direction. So rules are always very specific and clear. And rules is assumed you under anything you call rule, they assume you know it, or you have to learn it. And you must do it. Because if you contravene with a rule, it's an offense. It is an offense. So rules are very specific, is assumed to be understood, and if you don't comply with it, you will pay penalty. There will be penalties for contravention. But principles is quite different in the sense that principles, in fact, principle gives foundation for reasoning. Principle will give you foundation for reasoning that, okay, if they will give you like several options, it is you that will now decide exactly what you want to do. And a typical example of that is, for example, this Google Map, for example. Now, if you want to go out in the morning or at any point in time, and you check your Google Map will give you several options. It is now left for you to choose, okay, which one do you want to follow? It will tell you that, okay, if you go through this route, you spend 20 minutes. If you go through this other route, you spend 30 minutes, to give you several options. Then you decide. That's a key, that's a way that principle works. So principle gives room for professional judgment. It's flexible. It allows you to interpret issues and adapt it to your condition, right? That's principle. So looking at in Nigeria now, this is our gap. These are our rules and principles. So if you look at this accounting standard that I explained to you, I said they are IFRS and IAS. Generally, IFRS and IAS are principles. They are not rules. They contain principles. You will see, for those of you that have been exposed to IFRS before now, they will tell you what to do, a guide. They will give you options, which one you want to choose. Then it's not left for you to apply it however the way that it suits you. Also, the company law, that one is rule. The local stock exchange listing requirement, that one is rule. So in Nigeria now, we can say we are using a mixture of rule and principles. But if you focus majorly on the accounting standard, we can say that, okay, we are using a principle-based framework. A principle-based framework. Okay, so that is all around regulations. Then we can move to regulatory bodies now. Do we have any questions before I move to regulatory bodies? Okay, if you don't have any question, I need you to note these assignments down. I need you to note this assignment down. I want you to discuss the arguments for and against a rule-based framework. okay, and a principle-based framework. I need you to write it down in your notes. I need you to please write it down in your notes. Now, let's move to regulatory bodies. We are done with regulations. Let's move to regulatory bodies. So in Nigeria, now the regulatory body I'll be talking to, I will be speaking with respect to IFRS and IAS. I mean, after today, I'm not sure you ever hear me talk about these other two, company law and local stock exchange listing requirement, because that is not our focus in SBR. Maybe I'll still talk about Financial Reporting Council, which I will talk about now, but the focus is accounting standards, okay? So who is the regulatory bodies in charge of accounting standard in Nigeria? So the regulatory body, we call them Financial Reporting Council of Nigeria, FRCN. This Financial Reporting Council of Nigeria was established by an act in 2011, which replaced the Nigerian Accounting Standard Board. So FRCN is now responsible for ensuring compliance with IFRS in Nigeria now. They updated the acts in 2020, and it came in with a lot of changes. The Financial Reporting Council of Nigeria right now is headed by Rabiu Olowo and is doing very well right now. Now, when they were established, they had some key objectives. And number one of those objectives is to protect the interests of investors and other stakeholders, which makes sense that this should be their first objective. This is their primary objective, to protect the interest of investors and other stakeholders. Because when you say a body is responsible for ensuring compliance with a reporting framework, which means that they are the ones that are going to ensure that companies do the right thing, right? Indirectly, what are they doing? They are protecting the interest of investors. The people that have provided resources to that company, they are protecting their interest indirectly. So in the act, the first objective of FRCN is to protect the interest of investors. That is what they are out for. Their second objective is to provide guidance on issues relating to financial reporting and corporate governance. To provide guidance on issues relating to financial reporting and corporate governance, which means that they basically would train and teach entities about financial reporting and corporate governance. And corporate governance is extremely important for financial reporting to even exist within an organization. A company that does not have a good corporate governance structure can never have a good reporting framework. It's not possible. A company where, majorly most one-man business, there's no corporate governance because it's that one man that is deciding, is the alpha and omega. If the company's revenue is 100 million and the one man says, guys, let's put 20 million in the account just so that we can evade tax. What would you do? There's something you can do, which we're going to still talk about today. But the corporate governance framework is non-existing. That means reporting will always fail within that kind of organization. So that's what the FRCN is trying to avoid, to ensure that companies are properly guided on issues around financial reporting and corporate governance. Also, when we have guided you, when we have trained you on issues on financial reporting and corporate governance, then do it. And that takes us to their third objective, to ensure the accuracy and reliability of financial report. To ensure the accuracy and reliability of financial reports. So to achieve this, they usually go for routine audits, just to check that companies are complying and companies are doing the right thing and all of that. So ensure that. Also, to ensure that good corporate governance practices are used or adopted by private and public sector entities. So again, since you have taught you about corporate governance, I mean, you can easily download the Code of Corporate Governance Framework from FRCN websites. Then do it. So they also check that companies have good corporate governance practices, whether you're a private sector company or a government company, which is a public sector entity. Also, they ensure high quality of service among professionals like the auditors, the valuers, the tax consultants, and other ones like that. Also, they harmonize the activities of professional bodies like ICAN, CITN, ANAN, CIBN. I mean, these are bodies like ICAN now. ICAN is the one that trains people that will become chartered accountants. They are the one that would monitor members. After you qualify, you still continue to be a member, you continue to pay subscription every year. So somebody must be around to check that they are doing properly, that the exam they are setting for you is of standard. The FRCN does that. They harmonize and check activities of professional bodies. And finally is to improve, because all of this will end up in the improvements of the credibility of financial reports. To improve the credibility of financial reports. So those are the objectives of the Financial Reporting Council of Nigeria. These are highly testable area. They can ask it, of course, so you need to have a good idea of it. Also, there's a student that is chatting me now and saying he can't see a link. What do you mean you can't see a link? Are you not on the group? Okay, now you see the way FRCN works, they have departments that they call directorates that deals with different sections of their operations. They have directorates of accounting standards. They have Directorate of Accounting Standard for private sector. They also have the same Directorates of Accounting Standard, but now for public sector. So these ones, the people in this department will majorly focus on IFRS, right? You also have Directorate of Auditing Standards. They have Directorate of Valuation Standards. They have Directorate of Inspection and Monitoring. They also have Directorate of Corporate Governance. So these are the areas they deal with, and they have different directorates for that. So majorly, this is the regulatory body that governs financial reporting in Nigeria. Okay, you see, ordinarily this should be the end of this topic, but I cannot stop here. Majorly because this IFRS we are talking about, which is the regulation for reporting in Nigeria, and which FRCN, based on their act, are supposed to be the one developing and monitoring compliance. I mean, the reality is that they are not the one that develops this standard. What we did in 2011 was to adopt it. So it's important you also have the knowledge of where this standard actually comes from. It's important you have that knowledge. So is there anyone that can tell me where does this standard comes from? Who develops these standards? Who developed these standards? Former said IASB. Okay, guys, I mean, I think you would really have to be talking, otherwise this class will be a long thing, because I would need you to be giving me figures. We have a long stretch of 17 weeks to take together, and you might be meeting like almost 37 times, no, like 34 or 35 times. So you need to, whether it's right or wrong, who cares? And you can actually talk. I would really like to want you to talk and ask questions as we move on. It's important for you, please. Okay. Ufoma said IASB. Yeah, I won't say you're wrong. You are correct. You're correct, but it's beyond one body. In fact, the body is, we call them IFRS Foundation. So IASB works under that IFRS Foundation. So let me show you. You see, when it comes to accounting standards, IFRS, okay, there is a complete structure behind them. It's not just a single body, it's a structure. They call it IFRS Foundation Structure. IFRS Foundation Structure. You see, this IFRS Foundation Structure, at the very top, we have the ALGA, which is the monitoring board. And this monitoring board, their focus majorly is public accountability of this structure. Public accountability of this structure. So they ensure that this structure is publicly accountable, that they are actually working in public interest, that everybody sees what they are doing. That's what the monitoring board does majorly. And this monitoring board appoints people we call trustees of IFRS Foundation. They appoint these guys, trustees. You see, The monitoring board does not do any technical stuff. They are just there to provide leadership and guidance. They appoint trustees. These trustees are the experts, people that have good knowledge of reporting, auditing, accounting. They have international exposure and experience. They know all of these things that I'll be teaching you in this class. They have good knowledge of them, trustees. And you see, these trustees, when they were developed, okay, they gave them 4 objectives. Number one of that objective of these trustees of IFRS Foundation, this IFRS Foundation, they said number one is to develop, let me call it, to develop a single global high-quality accounting standard in public interest. That's their first objective, to develop a single global high-quality accounting standard in public interest. I mean, their aim was that every country of the world should use IFRS. That was their mission. That was the vision they had, that every country of the world would use it. So they developed is to develop a single global high-quality standard. Their second objective is not just to develop, but to now promote the use and rigorous application of the accounting standard. To promote the use and rigorous application of the accounting standard. This they have done very well. I have to tell you, they have done this part so very well. Promoting the use and rigorous application fantastically well, because almost over 100 countries of the world uses IFRS. That's impressive. Almost all African countries uses IFRS. Most countries in Europe uses IFRS. Most countries in Asia uses IFRS. In North America, South America, I mean, any continent mention it, they use IFRS. So they have done well. Number 3 is that they said they will take care of the need of SMEs in emerging economies. This actually helped them because they focused on emerging economies. They focused on SMEs in those emerging economies. And number 4 is to converge and harmonize international accounting regulations. So where this worked for them was areas where there are some countries that don't want to adopt this IFRS. Okay, they will just say, okay, if you don't want to adopt, fine, but can we have an accounting regulation that is similar? Can we have standard that is very similar, right? Those were what they were trying to achieve. Those was what they were doing, especially with the United States, because United States, even up to now, is not adopting IFRS and they won't adopt it. So what they are doing with the US is to harmonize and converge this IFRS with that of the US. In fact, most new IFRS that is being issued now, or most IAS that are being amended now, they are making sure that it's similar to the regulation, the accounting regulation of the US. Like this IFRS 18 that just came, similar to the US. The IFRS 15 that we have on revenue, similar to the US. The IFRS 16 on leases that eliminated segmentation of lessee accounting into operating and finance lease, similar to US. The expected credit loss model we have in IFRS 9 is similar to the US. So most accounting regulation now is moving, in fact, IFRS 9 is moving towards that. And that's their fourth objective. That's what they're trying to do. Okay, if you have a major powerhouse, a country that don't want to adopt IFRS, can we ensure that our regulation is converged, is similar, okay, which they are doing very well. Okay, so that's the trustees. So technically, to the person that said that the IASB is responsible for developing the IFRS, technically it's actually the IFRS Foundation. Okay, that's the IFRS Foundation. So you see, this IFRS Foundation, they have three bodies that work under them. Three bodies that work under them. Number one is IASB. Number two is ISSB. Number three is the IFRS Advisory Council. These three bodies, they work under the IFRS Foundation. So, I mean, if an examiner asks you, what's the objective of any of these three bodies? I've seen them ask, what's the objective of IASB? Please just give them these four objectives, because that constitutes the objective of any of them as well. But specifically, what the IFRS Foundation did was to delegate the work of developing IFRS to IASB. So IASB is known for developing IFRS, which was why I said, when the former said, okay, IASB, I didn't falter, because technically, I mean, generally you're right, but I mean, you need to understand that the sole responsibility lies with IFRS Foundation. They only delegated it to the IASB. And the full meaning of IASB, in case you don't know, is the International Accounting Standard Board. International Accounting Standard Board. There's another body that came in 2023 called ISSB. What these ones develop, they develop sustainability disclosure standard. Sustainability disclosure standard. I'll be teaching you this. We don't teach these standards before, but I mean, Nigeria has adopted it in 2024. So there are two standards that have been issued by the ISSB up to date, IFRS S1 and IFRS S2. We're going to be discussing them much later into the diet. So this ISSB, they work under the IFRS Foundation, and their own focus is sustainability reporting. They issue standards on how companies are supposed to disclose their sustainability activities. And the full meaning of the ISSB is the International Sustainability Standard Board. International Sustainability Standard Board. And there is the IFRS Advisory Council. This IFRS Advisory Council, you see, from their name, one would think that they provide majorly advice. Yes, that's what they do majorly. But really, what they do is they serve as like a formal link between the bodies and the professionals in practice or in public. So you see, this IASB and ISSB, whenever they need information, whenever they need opinions from the public, the body that help communicate to the public, that interact with the public, is this IFRS Advisory Council. So the ISSB goes through the IFRS Advisory Council whenever they need such information. So the IFRS Advisory Council they serve as a formal link between these bodies and professionals in practice. Okay, now let's not forget, before I forget, the IASB, underneath the IASB, there is a body called IFRS Interpretation Committee. This IFRS Interpretation Committee, from the name, we can conclude that they provide interpretations on IFRS, which is okay, which is correct. But this interpretation they provide on IFRS is not on all IFRS. It's only on IFRS where there is different interpretations, different opinions on how it should be applied. So when we have an IFRS that people cannot easily apply, or we have different sects of professionals that have conflicting opinion on how its application should go, then that's where this interpretation committee will come out and say, this is how we should do it. This is how we should apply this standard. That is what the interpretation committee is meant for, okay, where there are different opinions. Additionally, is if there is no existing standard on the transaction or event, if we have a transaction or event and we don't have a standard that governs it, they come up with an interpretation that, okay, pending when we come up with a standard on this area, this is how we should treat this item. And they did that for cryptocurrency, I mean, Bitcoin, if you're familiar with that, where it just came out and companies were investing in it, buying it. I mean, accountants didn't know how to treat it in the books. So they came up that, okay, there's no standard on cryptocurrency right now. But for now, when you invest in cryptocurrency, treat it as an intangible asset. However, if you are holding it for the purpose of reselling it, then keep it as an inventory. So they came up with that interpretation that time, and it really resolved the entire issue. And this is the structure behind IFRS in the world, from the monitoring board, who ensures there is public accountability and leadership in this structure, to the trustees of IFRS Foundation that are saddled with the responsibility of developing these standards, to IASB, whom the IFRS Foundation delegates that responsibility to the ISSB that came in 2023 to take care, to provide global baseline for sustainability disclosures, and the IFRS Advisory Council would helps these bodies to get opinions, comments from professionals in practice. And also under the IASB, there is the Interpretation Committee that provides interpretations where there are different opinions on how a standard should be applied, or where there is no standard on the transactions or events. They come up with how that transactions should be treated, pending when there would be an accounting standard. And may I mention that this monitoring board, who provide leadership to this structure, when you scrutinize them deep down, then you find out that the members of this monitoring board are majorly capital market authorities. You find out that they are capital market authorities. And when I say capital market authorities, I mean SEC, something like SEC. So it's like the SEC of every country is being a member of a body called monitoring board. And you know that SEC, they are the regulator for most listed companies anywhere in the world. They understand the reporting requirement of those listed companies. They understand their operations. They understand what they need to report. So being the one that provide leadership to a body like this, I mean, that's the right set of people that should be there. That's the monitoring board. Okay, so that's the IFRS Foundation. Now, before we move away from here quickly, let me quickly tell you about the steps in developing IFRS or accounting standards. even though the accounting standard in question now is IFRS. What are the steps in developing it? So you see, this step one, we call it agenda consultation. Agenda consultation. So when they want to develop an IFRS, the first thing that is done is to consult, to ask, to interact with professionals in practice, to ask them what are the accounting issues that they have. So this consultation is a process of identifying accounting problems and issues. That's consultation. And I mean, that should tell you that the process of developing IFRS is not a closed process where some set of intelligent or geniuses sits down and start writing standards. No. It's an open and transparent process where everybody is involved. In fact, their mission is to ensure that the best brain anywhere in the world is involved. You can be involved as well. Just go to their website and register ifrs.org. You will get all of these documents. So you see, this is their consultation. All the accounting issues they observe, they codify it somewhere called a work plan or an agenda. This work plan is being discussed and reviewed every 5 years. So they would be putting it together at the end of a 5-year time. They will sit down and look at it. Now, okay, these are all the accounting problems we have established. It's like they have a work plan meeting every year to discuss what they have identified so far. But at the end of 5 years, then that's when they will sit to decide, okay, which of these accounting problem is critical and which of them should we work on immediately? Which of them should we work on immediately? So if they're able to choose one to work on, to develop a standard on, then that takes us to step 2, which is research program. Research program. Meaning they carry out research, investigations, trying to understand the accounting problem critically, trying to find a way to solve that problem, trying to get empirical, do an empirical review of this and practical review of it, just to ensure that this is a problem that solution can be provided for. So on this, usually they will come up with a research report or a research paper called a discussion paper. This discussion paper would contain details of their findings on that accounting problem, and this discussion paper will be shared with professionals in public. They will share it with professionals in public. That, okay, guys, look through this discussion paper, look through this accounting problem, and we want you to tell us whether this problem is actually valid, does it exist? And this solution we have found out that we can use to solve this problem, is it viable? I mean, they would have a lot of them, so people will read it. I mean, this discussion paper can be out. It's usually out for like 90 days. People will review it, then respond to it with their comments and opinions. They look at it again, they refine it and all of that. Ultimately, at this level, the ISB or IFRS Foundation would be able to know whether a standard can be developed for this problem, or whether this is a problem that cannot be solved, or whether this is not even a problem. It could be that it's not a problem. It's not an accounting issue that we should work on. It is at this level they either proceed or kill the project of developing standard on that area. So if the resolution is that, okay, let's develop standard on this area, then they go to step 3, which is the standard setting, standard setting program. Step 3, standard setting program. Now, in this standard setting program, this is where they would, in fact, the first thing they do here is they'll come up with a proposal. They'll come up with a proposal for an accounting standard, meaning where they would have, okay, the recognition criteria, measurements, everything, the accounting treatment for that accounting problem. And that proposal for accounting standard, we call it an exposure draft. It's an exposure draft. These exposure drafts, they send it out to the public to look at it. Everybody looks at it. Everybody make comments. Everybody, I mean, there are some that people will say, okay, this treatment is fine. People would object some. This exposure draft also will be out for like 90 days, circulating, people looking at it, people commenting on it. Then after 90 days, they will sit down and look at the opinions and comments of people. They will refine this exposure draft. If they are okay with the comments and opinions from people, then fine. If they are not, they will send it out again, an updated exposure draft for public opinions and comments. And they can go on and on for years on this. Finally, under this step 3, this exposure draft will finally become an accounting standard. In this case, IFRS. Eventually, it becomes an IFRS. That should end the process, but no, they have a step 4. And this step 4 talks about maintenance program. This is like where they carry out what we call a post-implementation review. Where they carry out a post-implementation review. And this post-implementation review is where they will look at the practical difficulties in applying that particular standard. Or where they will look at whether people, there's conflict of opinions in applying it and all of that. Okay, let me ask you guys a question now. So at this post-implementation review stage or this maintenance program stage, let's say they find out that people are finding it difficult to apply or interpret. Which among the bodies I told you would help solve that problem? Which body do you think would help them?
The Protection Committee.
Thank you very much. Thank you very much. That's the interpretation committee. Correct. Now, in addition to that, this discussion paper, exposure drafts that is sent out to the public, which body actually helps them do that? Which body does that for them? Among those bodies we talked about.
Advisory Council.
Sorry?
Advisory Council.
That's correct. Advisory Council. Okay. So that is the end of this topic. But there's something I'm supposed to still talk about, but I'm going to give you as your second assignment. And that is talking about, I need you to write this down in your note. What is it talking about? Discuss the rationale behind regulatory or regulation of business reporting in Nigeria. This is a past question, and it was for 8 marks when they asked it that diet. 8 marks. So that's your second assignment for today.
Please, what's the first? My network has been messy.
The first assignment, this is the first assignment here. So when we come next week, that will be the first thing I would ask you. Any question on regulatory framework?
Do questions come out on this part, or you are just teaching us for knowledge sake?
Sorry, what's it?
Do questions come out on this regulatory framework, or you're just teaching us for knowledge sake?
There's no time to just be teaching topics for knowledge sake. It comes out in the exam. Let me share my screen. Let me see. Let me show you some past questions. Everything I teach you, it comes out in the exam. And this part is particularly important. Let me show you some questions. Some past questions they have asked before now. Okay. Can you see my new screen?
Yes, sir.
Okay.
Yeah, we can see it, sir.
Okay, good. So this is a question in May 2022. The examiner says that what are the major benefits and basic criticism of principle-based accounting standards? What are the major benefits and basic criticism of principle-based accounting standard? So I think this is the one I gave you as assignment, Abi, and it was for 10 marks. So please, I need you to research on it. It's also in your note, but luckily I haven't shared the note with you. So I need you to research on that area today. I want you to read on it. The B part says, what are the consequences of transiting from a rule-based to principle-based accounting framework, our accounting standards? What is this one talking about?
Rule-based and principle.
The difficult of changing from from rule-based to principle-based.
No.
I think it has to do with the implication and the what should be taken into consideration, like a guide to avoid maybe like a pitfall from moving from one of the from rule based to the principle. What should be taken into consideration before taking that action?
What should be taken into consideration before taking that action? No.
Is the advantages of principle-based over rule-based?
No. You're very close. Is the opposite of what you have said. is the advantages of rule-based over principle-based, not principle-based over rule-based. Because they say, what are the consequences of transiting from rule-based? It's like saying that, what's the consequence of leaving our school, equity, to another center? What's the consequence of leaving equity? Meaning that you would miss out on everything about equity. If you leave equity, you miss out. So the consequence of moving from rule to principle, the consequence, of course, consequence could be positive, it could be negative, right? So this B part is more of saying the advantages and disadvantages of a rule-based framework. That, okay, you want to move away from, you want to leave rule alone. Like you want to break up with your friend. What's the consequence of that? If you break up with me, you face the consequence. You face the consequence. That's the advantages or disadvantages of leaving that person. So the consequence of transiting from a rule-based to principle-based is like the advantage and disadvantages of a rule-based framework. Okay, another one, which I also gave you an assignment, is they said, appraise the rationale behind different regulatory frameworks for corporate financial reporting, 8 marks. This is like saying, why is regulatory framework necessary? Why is it important? So I need you to make research on this. These are past questions. Also, they say that analyze in detail the various sources of regulation for corporate financial reporting in Nigeria. What do you think this one is talking about? Which part of what I taught you is this talking about?
The three categories of
If you can't remember, just tell me. List them for.
the three regulations: the accounting standard, company law, and the local stock exchange listing requirements.
That's absolutely correct. That's absolutely correct. Okay, that's good. And there are more questions. There are more questions that they have asked so far. This is just up to 2022. And I have more questions that you can check. So in fact, let me give you another assignment. I'm sorry, but I'll be bombarding you with assignments in this class, which you have to do. It's important you do them. Let me share my working notes. Okay. Another assignment. I want you to, your second assignment is review past questions from 2021 to 2025 on regulatory framework. So anywhere they ask regulatory framework, review it. Review any 3 questions. Let me just say any 3 questions that you can find. So I will ask you which questions we're able to find out in the past questions in our next class. Okay. So the lady that asked me that question, what is your name again? Sarat Mustafa.
Sarah.
Okay. So it's not just for knowledge sake, it's what will come out in the exam. We have a lot to cover. That everything we are teaching you, yes, we'll teach you a lot that's for knowledge sake, but everything I'm teaching you here is you are going to find it in your exam. It's not for the purpose of discussions, no, exam questions. Okay, so ethics in reporting. Now, for this topic, I'm positioning it on the first day just because you understand certain things around ethics before we start teaching you a lot of these principles that you're going to use to prepare and present an annual report. Because we accountants, we have a certain level of power to a large extent that we can manipulate reports if we want to, because of the skills that we have in understanding of accounting language. Because of that, almost every course in ICAN now has ethics inside. And you always find it in the exam now. They always ask questions around it, just for them to understand that you understand and appreciate ethics and that you're going to be an ethical person. Depending on what you write in this part of your exam can even determine whether you pass or whether you will not, because we take it very seriously. So when it comes to ethics, we are saying that do the right thing, even though we know that you as accountants, you possess the ability and power, if I would put it that way, to mislead investors or to manipulate financial reports. But this part of your syllabus wants to teach you that don't do that. You must at every point in time ensure that you do what is right as an accountant. And that's what ethics wants to look at. So in the next few minutes, I will just quickly put you through what will guide you to ensure you do the right thing. So ICAN has a code of ethics. IFAC also have the same. In fact, we adopted our code of ethics from that of IFAC, International Federation of Accountants. So there's something we call in that code fundamental principles. Fundamental principles, which is the guide for us accountants that we have to follow, that we must have at the back of our mind and ensure that we remember it every time. And the first of it is integrity. The second is objectivity. The third is professional competence. Professional competence and due care. The fourth is professional behavior. The fourth is confidentiality. These are the 5 fundamental principles that guide us as accountants. The 5 fundamental principles that guide us as accountants. Looking at this, the last one, for example, which is the one that can easily be broken, right? Nobody cares about you knowing the definition of any of these. We don't care. We just need you to understand these principles, because they will give you cases in the exam and ask you for your opinion and ask you for the ethical issues or ethical implication of that case, which I will show you some of it today. So now, confidentiality, for example, now. I mean, accountants, whether you are an auditor, whether you are a tax consultant, we usually get a lot of data from our clients as a result of us, that because we are acting on their behalf, they give us a lot of their data, their accounting data, a lot of their contracts, a lot of their confidential information. They give it to us. You see, you as accountants, you as an auditor, you as a tax consultant, you see, on no account should you disclose this information to a third party that you are not authorized to disclose it to. except if the company authorizes you that, okay, give this to FIRS, give this to LRS, give this to CAC, give this to CBN. Is only if they have authorized you to give it to that event. On no account should you give your client's information to a third party without proper authorization. If you do that, that's a big one against our confidential, our fundamental principles. So any data, any information you get, because you are acting on behalf of your client, because you are acting in the capacity of an auditor, don't ever disclose it. That's what we mean by confidentiality as an accountant. Another one is professional behavior. You see, there's a difference between, are you an accountant? I mean, so somebody sees you and says, are you an accountant? Because by the time they look at the way you talk, when they look at your appearance, when they look at the terminologies you use, the way you carry yourself, are you an accountant? It's different from, you said you were an accountant. You said you were an accountant. It's different. There are two different things. One is saying that by the time they look at the way you are behaving, you are not behaving like a professional. So professional behavior is a principle for us as accountants that we have to follow, in that the way you talk, the way you express yourself, the way you present yourself has to be professional. You have to act in a very professional manner as a professional accountant. So even though you guys have not qualified yet, but it still applies to you because you are a professional student. If you are still a student, you are a professional student. When you pass your exams, all your papers, you become a qualified student. When you do your induction, you become a chartered accountant, right? But now, as a professional student, you need to behave professionally. It's important that you behave in a professional manner. Then we have professional competence and due care. In that, any project you're working on, any assignment you are given, you must attend to it to the best of your ability. You must do it to the best way possible. Even to the point when you qualify and you become a chartered accountant, see, ICAN requires that you get 120 credit hours every day, meaning you must attend trainings for like 120 hours for the whole year, and it's compulsory. If you don't do those trainings, you cannot get anything from ICAN. They will not give it to you. They will ask you to go and get those trainings that you have missed. So every year, at least you must get 120 credit hours. All is just ensuring that accountants are professionally competent and they act with due care. I mean, if you are in a gathering and you don't know about the subject matter they are talking about, it makes sense not to even say anything. Just look. If you are in a gathering where you have good knowledge of what they are talking about, then you talk. Silence can be golden in some instances, in some gatherings. Another one is objectivity. You must never allow undue influence of others to affect your professional judgment. You must not say, because it's my friend, so I will do the wrong thing. Because she be his aim, so let's allow it. No, you have to be objective. Your boss must not say, no, this one does not matter. Let's present it this way. when you know an item that you're supposed to expense, they say you should capitalize it. And it's okay. It affects your objectivity. You have to ensure that undue influence of others, okay, does not affect your professional judgment. And the final one, this is the subtle one, the one that defines you as a person: integrity, honesty, being straightforward. This is what defines you. It may not be in the short term, but in the long term, this is you. You have to be someone of integrity. There's no way out of here. This has to be intact. So, as we teach you most of these principles you'll be learning in reporting, you need to remember these fundamental principles. ICAN will ask you in the exam. You want to be sure that you understand it very well. I mean, there are some students they will fail because they will always find questions on ethics, and they will ask you questions. They will tell you about somebody that is trying to do something wrong. You have to be very careful with questions like that. If you go and write what you're not supposed to write, they will not allow you go. Even if you do, they'll say, no, this person will be a problem for us in practice. Let's allow him wait another 6 months. Let's see. If he comes next diet, let's see what he will write. You have to be very careful. We take this extremely seriously. Professional or fundamental principles. Now, you see, these fundamental principles, there are a lot of activities and events that will happen in practice that would not want you to follow it, that will always want you to break it. I mean, a lot. We call those ethical threats or threats to fundamental principles. These ethical threats, there are 5 of them as well. Number 1 is self-interest threats. Number 2 is self-review threats. Number 3 is intimidation threats. Number 4 is familiarity threats. Number 5 is advocacy threats. So these are the description of the threats that would make you go against the fundamental principles. Like you see this one, this self-interest threats. It's not the name self-interest threats that matters in the exam. What matters is for you to understand the events or actions or occurrences that are self-interest threats. So for example, any actions or activities that will make you do the wrong thing because you know that if you do the right thing, you would suffer financial loss or you will lose some financial interests. So this is more of when you are going after your own selfish interests to do the wrong thing. So for example now, let's say your company has a benchmark of, let's say 10 million, that if they make a profit of 10 million, they would give bonus to everybody. Everybody will get a bonus at the end of the year if profit for the year is 10 million. So close to the year, you then remembered that there is a provision or an impairment for receivables that you need to make. And when you make this impairment for receivables, you will need to expense like 2.5 million to P&L out of that receivables. And when you do this, that profit will not meet up anymore because it reduces the profit to lower than that 10 million, and you will not be able to get that bonus anymore. So you did not make that impairment. You did not make that provision. You ignored. You went ahead to submit the account without the provision. You see, that's action, that activity, that event is a self-interest threat. Because you're thinking that if you had done the right thing, you will lose money. You will not get bonus. But rather, you gave in to that threat, that financial gain for that moment. And you went ahead and ignored and did not do the right thing. That is a self-interest threat. So a self-interest threat is events where you decide to do the wrong thing because of avoiding financial loss, because of your own selfish interest. Another one is the self-review threat. And this happens where you prepared a data or an information and you happen to be among those that will review that same information. You were the one that prepared it, and you are also part of those that will approve it. It can result in a self-review threat. Just like you prepared a budget. They said finance department prepare a budget, and you are the head of finance. When they prepared the budget, of course, they submitted it to the management, and you are part of management that would approve the budget. During the approval process, a lot of people were punching holes into that budget, and you become defensive. You become defensive that no, you're trying to defend everything, whether they are right or wrong, just because you were the one that prepared it. That's actions. That event is a self-review threat because you prepared and you are also in the position to review or approve that work. That's a self-review threat. And that is why it is highly recommended that if you are the external auditor of a company, you are not also the tax consultant, because, I mean, it can result in a self-review threat where you don't want to recheck and correct your work. Since you are the one that did it, you assume it's correct. So if you are the tax consultant that you compute the company's CIT for the financial year, and you're also the auditor. Auditors are supposed to review that. They're supposed to check it again to its correctness. But because you're the one that did it, of course you will not check it again. You assume it's correct. And the reality is that if a second eye looks at it, the difference between the tax payment for the company might be material. I mean, I've been on one where the difference between us, the tax consultant, and the auditor was going to close to 200 million when they completed years. So those are events that can result in a self-review threat. When you're the preparer and you are also the same person that is approving or reviewing that same work. Intimidation threat arises when you have a boss that is asking you to do the wrong thing and is saying that if you don't do that wrong thing, he will fire you. That is an intimidation threat. And a lot of people will, of course, give in to that. When you are in a situation of an intimidating boss or an intimidating client, that at every point in time, they are telling you, if you don't do this, we'll get another person. We'll get another. That's intimidation threat. That event, because it can make you do the wrong thing. You need to stay away from that because it will affect everything here. all your fundamental principles will be punctured, will be affected. Intimidation threat. Another one is familiarity threat, where you as an external auditor, you become too close to your clients, or you become that your association become so familiar. Is a problem that you are now accepting gifts, you are giving gifts, exchanging gifts, becomes a problem because your objectivity will be impacted because you will not want to do the right thing. At a point where they will ask you for favors, you might not be able to say no. So usually we want to limit relationships between auditors and clients. It should not be personal. It should be professional at always. So even the association should be minimal, just to avoid familiarity threats. And which is why usually there is always auditors rotation, just so that by the time an auditor is with you for too long, the familiarity becomes too much, the fundamental principles will be affected. And finally is advocacy threat. When you become an advocate of a third party, or let me say your clients, advocate in the sense that you're speaking for them, you're talking on their behalf, you're advertising and promoting their product, for example. There's nothing wrong with that, really. But it becomes a threat where you are not sure of the correctness of what you're talking about, when you don't know whether it has scientific backing, when you don't know whether it's right or wrong, or when you even know that it's wrong and you are still saying it. Or they invite you to come and testify in a court of law and you go ahead to testify and you're not sure whether all you are testifying for is right or wrong. You don't know. You just say, she is my client. I don't want them to face any trouble. Let me go and talk for them. That's an advocacy threat. It is an advocacy threat because you'll be doing the wrong thing.
Please, I don't get that advocacy threat. Can you take it again?
So when you are speaking on behalf of, let's say, your clients, you see, speaking on behalf of the client is not even the problem. You can speak for your clients, for anyone, provided what you're saying you're sure that is right. But where you're saying or speaking on behalf of your clients and what you're saying is wrong, is either you know that is wrong or you are not sure whether what you are saying is right or wrong. You just want to, or like, for example, you go to the court of law to testify for your clients. They called you that you should come and testify for them. Probably maybe they are facing a case and you go ahead to testify and you agree to a lot of things and you're not even sure, you don't have facts to affirm that what you are talking about is right or wrong, or what they ask you to testify for is right or wrong. So whenever you're speaking on behalf of your clients and you are speaking the wrong thing, what is not right, or you yourself, you are not even sure whether what you are talking about is right or wrong, that is an advocacy threat. Speaking the wrong thing on behalf of your clients. You're speaking for them, but you are lying just to make your client happy. You're promoting their products that you can do A, B, C, D. When even you yourself, you have not verified that you can do that A, B, C, D, but you just want to go ahead and do it because they are your client. That is advocacy threats. Promoting the interest of your clients, speaking on behalf of your clients, and these things you're talking about, you have not affirmed their correctness. You have not affirmed that it's going to mislead the people that you're speaking to. You just go and you're just saying it. It's an advocacy threat. We have to stay away from that. You see, the reality is that we are going to be faced with these threats. Examiner will give you questions around these threats, events, circumstances that would make you do the wrong thing, just so that you want to maintain a relationship, just so that you don't want to lose something. These are threats. When you're faced with that, you need to understand that one, is going to impair your fundamental principles, and two, you must not do them. So what are the actions that you must take when faced with these ethical threats? I will call that safeguards. Safeguards. The actions you must take. Number one is to communicate with your line manager about the ethical issue. You communicate with your line manager about the ethical issue. So if the person that is asking you to do the wrong thing happens to, for example, be your boss, I mean, the first thing is to communicate with that person. Or if it is you yourself, you need to communicate with yourself. If you are the one that, because of your financial gain, you are doing the wrong thing, I mean, you need to talk sense, communicate sense with yourself. That's communicating. And even if it happens that your boss is, for example, your MD or your CEO or the topmost person in that organization, then, I mean, in that case, if it is a well-structured entity, then you can communicate with the audit committee of the board. Yes, you can communicate with the audit committee of the board. These ones are beyond the MD because they're a committee of the board. They contain executive and non-executive directors majorly. So they have powers. Hopefully at this level, it should be resolved. If it is not resolved at this level, then you might want to escalate. You might want to escalate externally to professional or regulatory bodies. If it's a serious issue, I mean, they would keep you anonymous, of course. And you might want to also even do the honor of resigning from such an organization. It's a last resort, but I mean, something you should consider. Leaving them, hopefully you get another job very fast. So these are safeguards to these ethical threats. So let's look at some scenarios that you might find in the exams. So, okay, please confirm that you can see my new screen.
Yes, you can see your screen.
Okay. So there's this question. They ask it every night anyways. But let's look at the few ones you have here. Look at this question. They said, the directors of OMI PLC, after reviewing the group statement of financial position for the year end November 30, 2020, of the opinion that the company might be unable to meet up with future loans agreements, which the company is planning to enter into early next financial year. And they have therefore suggested the following to improve liquidity position of the group. Number one, to factor company's receivables, which amounted to 400 million. Thus, the company would receive cash of 80% of the amount immediately. The factoring company will charge a fee of 32 million for their services. The debt will be factored without recourse to the group, and the balance will be paid to the factoring company 30 days after the receivables are factored. Number two, the executive director marketing services suggested that instead of entering into a factoring contract, it would have been better if the financial statements are adjusted to appear as if land located in Ikoyi has been sold before the year end, and thereby making the liquidity position better in order to meet up with the future loan agreement required. Discuss the rules of IFRS 9 financial instruments relating to the recognition of the financial assets. Apply these rules to the suggestion made by the directors in B1 above, and discuss the ethical implications of the suggestion made by Executive Director Marketing Services in B2 on the issue of the sale of land marks. Okay. So this one comprises two questions, but the one that concerns us is these two, this second part, because we have positive IFRS 9. So this second part, look at what this Executive Director Marketing Services is suggesting. I think the company is faced with a liquidity issue, and they are trying to improve their liquidity position for the end. So the guy is saying that, but what they can do is that the land in Ikoyi, that the land they have in Ikoyi, that they should make it look as if they have sold it before the end, thereby making the company's liquidity position better in order to meet up with future loan agreement. So what they will now do is they will remove the land from their books. They will now show cash that will be higher. That's what this guy is advising them. So apparently, nobody needs to tell you before you know that that is wrong. Okay? So the examiner is now asking you that you should discuss the ethical implication of this. I mean, the first thing here is this. That would comprise what we call, let me ask you, which threats do you think this company is faced with in this case? Which of the 5 threats that we mentioned?
Sir, it is self-interest test, and is likely to be also self-review threats. But all the threats on this thing, sir, is self, sir.
Yeah, because the company, as far as at the company level, they are looking at what they want to gain is majorly a self-interest threat for the company, because they want their financials to look good just so that they can get loans from the bank. So you need to tell the examiner here that the implication here is this. This event is a self-interest threat because this company wants their financials to look good, which will not show their underlying economic activity. That is against almost all the fundamental principles, especially integrity. They are being dishonest. And that treatment against is also against the accounting standard. You cannot derecognize a land from your books unless you have sold it. And this company has not sold this land, so they cannot derecognize it from their book. And what should be done is to ensure that they do not follow the advice of that, because this is a director. Who do they want to report to? And they are not even asking anybody to report to anybody because it's not affecting anybody. They are sitting down. you would strongly advise that this company should not follow through with the advice of the director, and it's better they go with the factoring options that they have so that they can get money by factoring some of their receivables. And that's it. That's the answer to this. So you'll have mentioned the threats, you'll have mentioned the principle, the fundamental principle is affecting, and you'll have also mentioned the safeguards, the actions that they can take. Okay, let's look at another diet. The same May 2023. This one says that on your first day at Omoge Nigerian PLC as the CFO of the company, you were sitting in the staff canteen where you overheard a conversation between two of the admin officers of the company. They were gossiping about Mr. Adamu Salisu, the finance director. According to the conversation, Adamu may have been involved in an unethical activities in respect of Omoge, Nigerian PLC takeover of Bobo. Adamu Salisu's wife is a director in Bobo prior to the takeover. Mrs. Salisu owned 30% of the shares in Bobo. It was suggested that Mr. Adamu, the finance director, overpaid substantially for Bobo, and that Mr. Salisu facilitated the overpayment in order to benefit his wife. He did this allegedly by colluding with his wife to falsify records submitted to the accountant, who undertook due diligence in respect of the takeover. Mr. Adamu Salisu is apparently not well liked. The admin staff regard him as intimidating, and it seems they would be pleased if he lost his job. Required. Discuss the ethical implications of the above and possible actions that may arise from the incidents. Okay, so for this one now, you see, they just appointed you as the CFO. You now went to the canteen. Some admin officers, meaning junior staff, were talking about your own boss, the finance director, Mr. Adamu, that the company, this your new company just acquired. Your company just acquired Bobo. You work with Omoge. They are saying that director overpaid for that company because his wife owns 30% of that company, and they have falsified his record to overvalue that Bobo just so that the wife will benefit. That's the issue. So what's the ethical implication of this issue, and what actions should you take? You see, I mean, for this one, for you, there's no threat to you personally, but based on the issue, the first thing you should do is to confirm, to find out, to do your own underground work, to affirm that what they are saying is correct. You can meet with those officers to get their source of information, just to be sure what they are saying is correct. Because Mr. Adamu, your guy, he was exposed to a series of threats based on that transactions. One was the self-interest threats, familiarity threats because of his close association with his wife, which affected his integrity and objectivity. So you now, the result of your findings, the first thing is for you to communicate with Mr. Adamu. That's the first action you should take. Communicate with Mr. Adamu. That's especially if the findings are not palatable, they are not so positive. You need to communicate with him that you reviewed the due diligence exercise that was carried out, and you find out that there were some gaps, and you strongly feel that those gaps need to be rechecked. That's the first thing you have to do, because it won't be fair to take it over him. If you can resolve it there, that's when you find out truly whether what they are talking about is right or wrong. Based on his response, you will know whether he intentionally falsified the account just to overpay his wife's company or not. And if it's true and he starts threatening you, then probably you take it over him to the audit committee of the board. Those ones will be in position to take the right action. So you communicate with him first. Then, if he doesn't resolve it at that level, you communicate to the audit committee of the board. If they don't resolve it at that level, you might probably want to resign from such a company if everybody is involved in such a shady deal. But the first action is to confirm, review those documents to be sure that the grapevine, the gossip is actually okay, but it's not something you want to overlook as an accountant. Okay, I'm going to stop here for today because our time is up. We have another class for 5 o'clock. So there are a lot of things I want to tell you guys, but I just needed to finish my target for today, which I'm done with. So, and unfortunately, we don't have time anymore. So this class is going to stop for today. I'll be sharing the material with you, the course outline, the class notes. You're going to have everything as soon as possible. Then we'll continue from there. So in our next class, which is going to be Wednesday, we are going to be starting with IFRS 2 share-based payments. And based on our plan, it will take us 3 classes to finish that. But let's proceed. Let's start first and see how far we can go and how fast we can move. Don't forget, I've given you like 3 assignments. Please ensure you do them. When we meet on Wednesday, we're going to talk more on how you ensure that you maximize this online class. I can see a lot of people not a lot of people, very few people exiting and coming back in. I don't know why that is happening. Maybe your internet access or whatever, but it's something you have to avoid completely. Or coming into the class late for whatever reason or the other is something you want to avoid totally. But I have another class by 5. I would restrict whatever I want to advise you on how you get the best out of this online class for now until Wednesday. So you guys should have a wonderful day ahead of you. See you on Wednesday. Bye for now.
Hello, sir. Hello, sir.
Hello.